Every modern nation carries public debt. That's not unusual. What is unusual is that the United States, the country with the largest debt in human history, also sits at the center of the global financial system. U.S. debt isn't just an American issue. It's the benchmark the entire world uses to measure safety, stability, and risk. And the story of how that happened goes back centuries, long before the dollar existed, long before there was a United States. The idea of public debt began in Europe. 17th century England, the Dutch Republic, and later France all pioneered government bonds backed by taxation. These early nations discovered something revolutionary. If you could convince the public to trust your debt, you could finance wars, expansion, and entire economies without needing piles of gold. When America was still a collection of colonies, Europe had already written the first draft of the modern financial playbook. So when the American Revolution ended, the newborn United States inherited a massive problem: war debt, 13 separate state obligations, and no unified tax system to pay for any of it. The country had freedom, but financially, it was fractured. Building a national economy meant building trust, and trust required a structure. Every major chapter of early American history forced the U.S. to borrow more. The War of Independence, the War of 1812, the Civil War, and the rapid industrialization of the 19th century all demanded money the government didn't have. Debt wasn't a choice. It was the only path forward. And yet, unlike most nations, America turned its growing debt into a source of strength. With a massive domestic market, a rising industrial base, and later the global dominance of the U.S. dollar, the United States could borrow more, longer, and cheaper than anyone else. Economists began to understand debt not as a weakness, but as a structural tool, fuel for a continually expanding system. This transformation followed a pattern. Debt becomes bonds, bonds become collateral, collateral becomes the foundation of money itself. That concept, imported from Europe, was perfected in America. Along the way, key figures shaped the system. Alexander Hamilton, who built the first national credit; J.P. Morgan, who stabilized markets by force of wealth, and later the architects of the Federal Reserve. Each solved a crisis of their era, unintentionally reinforcing a larger design. And that brings us to the central question of this series. How did a system built on debt not only survive, but become the engine of the world's largest economy? To answer that, we go back to the beginning, to Hamilton, and the moment the financial architecture of the United States was first drawn. When the United States won its independence, it inherited something far less glamorous than liberty: debt. A lot of it. The young nation was financially fractured. 13 states issuing their own IOUs, borrowing separately, running their own fiscal policies. War bonds were trading at pennies on the dollar. Confidence in the new republic was so low that even American citizens doubted their government could ever repay anything. The political union existed, but financially, the country was a patchwork. Into this chaos stepped Alexander Hamilton, brilliant, controversial, and arguably the most visionary economic mind America has ever produced. When President Washington appointed him as the first Secretary of the Treasury in 1789, Hamilton believed one idea above all others: a nation is only as strong as its credit. Debt, to him, wasn't a burden. It was the seed of national power. So he proposed something radical. The federal government would absorb the debt of all 13 states and merge them into a single, unified national credit. Investors would no longer bet on Virginia or Massachusetts. They would bet on the United States. The plan ignited political firestorms, but it restored faith almost immediately. For the first time, America had a financial identity. Hamilton didn't invent this from scratch. He studied Britain's financial system closely, especially the Bank of England and its long-term bond markets. His conclusion was clear. Great powers are built on stable public debt. So he structured U.S. bonds to pay reliable interest, creating a loyal, invested class that had a direct stake in the success of the federal government. This vision led to the creation of the first Bank of the United States, America's earliest attempt at a central bank. Its goal was simple: stabilize the currency, support taxation, and manage the new national debt. But it faced fierce opposition from Thomas Jefferson's faction, who feared a strong federal financial system would resemble the very empire they had just escaped. That political divide, strong central authority versus decentralized power, became a permanent feature of American economic politics. The first bank fell, and a second bank rose, only to be brought down by President Andrew Jackson. Without a central authority, America returned to financial fragmentation, while the West expanded. Railroads stretched toward the horizon, and states and companies borrowed heavily from Europe to build the nation's infrastructure. A new class of financiers emerged: merchant bankers and railroad tycoons, connecting Wall Street to London and proving how powerful long-term debt could be. Yet by the late 19th century, America had everything except one crucial feature: a stable, unified financial center. And that void would soon be filled by the rise of powerful financiers like J.P. Morgan, whose influence would force the United States to confront the need for a true central bank. By the late 1800s, the United States was transforming faster than any nation in history. Railroads stretched across the continent, steel mills lit the night sky, and oil derricks rose like metallic forests. This explosion of infrastructure didn't just reshape the land, it created an unprecedented hunger for capital. Out of that hunger emerged enormous industrial empires, and behind them, the financial titans who would come to dominate American markets. But for all its ambition, America's financial system was dangerously flawed. Unlike Europe, where national banking systems had matured for centuries, the United States was fractured. Every state had its own rules, its own banks, its own vulnerabilities. Most banks held extremely small reserves. A single rumor could spark a bank run. And when panic struck, as it did in 1873 and again in 1893, markets collapsed, railroads went bankrupt, and thousands of banks failed. The federal government had almost no tools to intervene. The gold standard made everything worse. Because every dollar had to be backed by gold, the money supply couldn't expand when the economy needed it. If the nation grew faster than its gold reserves, credit dried up and panic followed. One shock in New York could cascade across the entire country. America needed stability, and in this void stepped one man: J.P. Morgan. Morgan was not a politician. He wasn't elected. And yet he had something no one in Washington possessed: vast private capital, deep connections, and unmatched authority on Wall Street. When markets trembled, he could summon bankers, railroad magnates, and industrialists into his library and force them to cooperate. In an age when trust was rare, Morgan's name alone could calm financial chaos. Then came the panic of 1907. A massive bank run swept across New York. Stock exchanges hovered on the edge of shutdown. The Treasury Department couldn't stop the bleeding. So Morgan did what no government agency could. He locked the nation's leading bankers in a room, demanded they pool their money, and personally orchestrated the rescue of the entire U.S. financial system. One man had prevented national collapse. The public was stunned. Congress was alarmed. and the question became unavoidable. How can the world's rising industrial power rely on a single financier to save it? The answer was clear. America needed a central bank, an institution capable of stabilizing markets, managing liquidity, and acting as the lender of last resort. So behind closed doors, senators and bankers drafted the framework for a new system, one that looked like a central bank, but fit American democracy. Their work would culminate in 1913 with the creation of the Federal Reserve, the institution that would reshape the nation's relationship with debt and money forever. By the early 20th century, the United States was an industrial giant, but its financial system was still fragile, fragmented, and prone to collapse. The panic of 1907 had shaken the country to its core. With bank runs spreading across cities and markets paralyzed, Americans realized a hard truth. The world's fastest-growing economy had no central institution to stabilize it. Congress, business owners, farmers, and Wall Street bankers all felt the same pressure. The nation needed a new financial architecture. The goals were clear. First, America needed a way to stabilize interest rates during crises. Second, it needed a lender of last resort, an institution capable of injecting liquidity into the system when panic struck. And finally, it needed a mechanism to support the government's bond market, because a modern nation could not function without dependable public debt. Debates in Washington were fierce. Senator Nelson Aldrich, inspired by European models, drafted the first plan. But after the 1912 election, Democrats demanded a more publicly accountable design. The result was a compromise, one uniquely American. Not fully centralized like Europe, but not a free-for-all either. In 1913, after months of political conflict, the Federal Reserve Act passed. The Federal Reserve System blended public oversight with private participation. A board of governors in Washington provided national supervision, while 12 regional Federal Reserve banks ensured that no single financial center, especially not New York, could dominate the system. Banks provided capital, but they didn't control policy. Congress had authority, but not operational power. It was a delicate balance, designed to prevent another era where the country depended on a single financier like J.P. Morgan to rescue it. World War I quickly tested this new system. The federal government needed unprecedented capital, and the Fed helped sell Liberty bonds to millions of Americans, stabilizing interest rates and proving its value in managing national debt. Then came the Great Depression. The Fed's early missteps worsened the crisis, but the catastrophe ultimately reshaped its role. Under Franklin Roosevelt's New Deal, the Fed and the Treasury worked hand in hand, creating the modern partnership between fiscal and monetary policy. Interest rates were controlled, liquidity was managed aggressively, and the federal government used debt as a tool to rebuild the nation. By the end of World War II, everything had changed. Europe and Asia lay in ruins while the United States stood alone as the world's industrial superpower and the holder of most of the world's gold. In 1944, the Bretton Woods Agreement formalized a new global order. The dollar anchored the world economy, and American debt became the bedrock of global finance. The foundation was set. The Federal Reserve had evolved from a crisis response institution into a central pillar of a worldwide financial system, one in which U.S. debt would soon grow larger, more influential, and more essential than ever before. In 1971, the United States made a decision that would transform the global financial system forever. President Richard Nixon ended the convertibility of the dollar into gold, breaking the final link between American money and a physical commodity. With one televised announcement, the world's most powerful currency became pure fiat, backed not by gold bars in Fort Knox, but by the strength of the U.S. economy and the confidence of global markets. This shift changed everything. Without the constraints of gold, the U.S. government gained the ability to expand the money supply and issue debt far more flexibly. Public debt was no longer limited by the quantity of metal in a vault. It became a macroeconomic tool. And the Federal Reserve, through its control of interest rates and open market operations, could now influence the entire financial system by buying and selling U.S. Treasury bonds. But the 1970s were turbulent. Oil prices soared. Inflation spiraled. The dollar weakened. Americans watched prices climb month after month, and the credibility of U.S. monetary policy faded. It fell to Federal Reserve Chair Paul Volcker to restore order. His solution? A dramatic interest rate shock. By raising rates to nearly 20%, Volcker crushed inflation, but at the cost of a deep recession. Borrowing became brutally expensive, including for the U.S. government. Yet this painful reset restored global faith in the dollar. Then came the Reagan era, reshaping fiscal policy once again. Tax cuts, military expansion, and persistent deficits pushed U.S. debt upward. But at the same time, America's global influence surged. After the Cold War, investors around the world, from Tokyo to Berlin, saw the United States as the safest place to store their capital. They bought U.S. Treasuries in massive quantities, transforming American debt into a global asset. A new financial ecosystem emerged. Pension funds, insurance companies, and foreign central banks accumulated trillions in U.S. bonds. Wall Street giants like BlackRock, Vanguard, and Fidelity rose to dominance, managing oceans of global capital and channeling much of it into Treasury securities. The dollar became the backbone of international trade, and the dollar-based global debt system took shape. A world where countries needed dollars, and obtaining those dollars meant buying American debt. As a result, U.S. Treasuries became the safest, most liquid assets ever created. And because global demand for these bonds seemed endless, the United States found itself in a unique position. It could borrow more, spend more, and maintain its global leadership, because the world needed its debt as much as it needed its currency. This era set the stage for the debt-driven economy of the 21st century, where America's borrowing became not a weakness, but the central pillar of global finance. By the 21st century, the United States had crossed a symbolic threshold, over $30 trillion in public debt. But unlike what headlines often suggest, this figure isn't merely a warning sign. It's the engine that keeps the modern American economy running. Debt, in today's financial system, is not just an obligation. It's the fuel that powers the nation's growth, stabilizes its markets, and anchors the global financial order. Who owns this enormous mountain of U.S. Treasuries? The answer reveals how deeply interconnected the system has become. The Federal Reserve holds a massive portion through its quantitative easing programs, absorbing debt to keep markets liquid during crises. Pension funds and insurance companies hold trillions more, using treasuries to guarantee the retirement and protection of millions of Americans. Banks and corporations treat these bonds as core collateral in everyday transactions. And beyond U.S. borders, nations like Japan, China, and members of the European Union collectively hold trillions, because U.S. debt isn't just an American asset, it's a global reserve. Modern monetary mechanics tie it all together. The Treasury issues debt. The Fed steps in when needed, buying bonds to inject liquidity. Banks use those bonds as high-quality collateral to acquire even more credit. In essence, the entire financial system is built on layers of debt that support everything from mortgages to corporate loans to global trade. And because the supply of money depends heavily on the supply of government debt, the system requires continuous expansion. If U.S. debt stopped growing tomorrow, the money supply would tighten and the economy could spiral into recession. The dollar's global dominance makes this system possible. As the world's primary reserve currency, the USD is essential for international trade, from oil markets to shipping routes to commodity exchanges. That means countries must hold U.S. bonds, even when America's debt climbs. There is simply no alternative with equal liquidity, transparency, and legal stability. Still, the long-term risks are real. Rising interest payments strain the federal budget. Inflation can surge if the Fed miscalculates. Younger generations inherit an economy more financialized than any before it. And new challenges loom. Geopolitical rivalry with China, the possibility of global downturns, and disruptive technologies like AI, blockchain, and central bank digital currencies. This brings us to the defining debate of modern economics. Should America tighten its belt or accept debt as the natural state of a superpower? Because the true question is no longer, does the U.S. owe too much? It is, what would the world look like if America didn't owe so much? And who would lead the global financial system then?